Welcome back. You're watching us here on Chartbusters. The stock on our radar right now is HLE Glascoat. It's a glass-lined equipment manufacturer. It's been buzzing off late. In fact, in the last 5-6 days itself, the stock has rallied all the way from 600 rupees to close to 660 odd rupees. They're a market leader in filtration and drying equipment. Let's understand the road ahead and the business of the company with Harsh Patel and Aalap Patel, both executive directors at the company. Harsh and Aalap, thank you so much for joining in. There's been some, interest in your stock lately with regards to the moves that we've seen. Just wanted to understand with your business. I mean, you have over 50% market share in India for ANFD. Glass-lined equipment is over 25%. And you say there are high barriers to entry. What kind of growth can you foresee going forward in the business that you're in, the industry and market share expansion?
So good morning, everybody. We already have a good market share in the filtration and drying business, as you rightly said. I think the industry will grow at about 15 to 20% in the coming days. That is the expected growth in our industry. And I think we will continue to at least outpace the industrial growth by a couple of percentage points in the next couple of years.
All right. Hi, good morning, Nigel. On this side, we have the other listed peers, GMM Pfaudler. And,
right.
y'all are saying that y'all are outgrowing the market. Could you tell us whether or not you're pulling some market share from GMM Pfaudler?
See, overall, we are pulling market share. The market share is coming from various other players. So, for example, in the glass line equipment, when we took over the company 6 years ago, we were at around 22% market share. Currently, financial year 23, we think we are at about well over around 30%, a little bit over 30%. That's what we think. So we are definitely pulling market share from others. We cannot really specifically say whether it is from GMM or from others, but we are definitely pulling market share.
Okay. All right. Well, the big point actually that, the street is focusing on is on the margins. Yes, you all went ahead and did some inorganic growth in Europe, and things didn't really play out initially. But now it seems there are first signs of margin recovery. So my question to you is, earlier you all were doing high teens margins, which fell to low teens. Now in the past quarter, it's around mid-teens. Have the worst of margins, is it behind you all? And will the margin trajectory steadily improve from here? Input costs are cooling off, supply side issues as well are getting sorted out, and you'll have a good order book. So I ask you this.
Hi. Thanks, first of all, Nigel and Mangalam, for having us. I think the financial year 2023 was a challenging year because of the geopolitical and macroeconomic situations. We had a steep rise in the input costs. And obviously, as a result of this increase, there has been an impact on the business margins. We saw the metal prices undergo some record volatility. Also, the gas prices grew very, very steeply in a very short time. Having said that, going forward, at least the input side seems to be a lot more stable. That's not our concern at all. On the demand side, we are seeing a little bit of a pressure. At least we see that the chemical and pharmaceutical sector, we see a pressure on both the order books and the margins. But we feel that this will turn around in the next quarter or two.
Okay, all right.
What we expect in terms of margins is that in the long run, we will be able to sustain our 17 to 19% range that we feel that we have always said is something that is sustainable.
All right, that's about the EBIT.
Definitely feel that the worst of margin is behind us. The worst of the impact on the margin is behind us. But other than the markets turning around, it will also take some improvement in business efficiencies from our side.
All right, so 17 to 19% sort of margins is what you expect going forward, and things will start improving for the next couple of quarters. But I'm looking at a couple of things, and they don't add up because it's a strong industry where you have over 50% market share. What explains your trade receivables being at 243 crores versus 148 crores? Your net working capital days at 74. Inventory days have increased by about 105 as well. What this has basically done is that I'm looking at data for the last 5 years. Your EBITDA has jumped from 47 crores in FY19 to around 137 crores in FY23. But not one of these 5 years has your operating cash flow gone beyond 50 crores. In fact, last year it was just 5 crores on an EBITDA of 137 crores. 10 crores in the previous year on an EBITDA of 111 crores. So, the operating cash flow, the EBITDA, they don't match up somehow. Can you give us can you explain to us?
Sure. So in terms of the working capital cycle, like in all capital equipment businesses, the working capital is slightly longer. And this is owed to a couple of factors. So first of all, we have a long manufacturing cycle time. We also have a large order book. And also we have a need to fundamentally keep our raw material positions covered. So owing to all of this, our working capital cycle is slightly longer. While we have done some work on getting the inventory numbers in control, while we have put a lot of focus on the receivables and payables, I don't think a shorter working capital cycle is going to be possible in at least the near term. The increase in the working capital cycle can also be attributed somewhat to the shifting trends in the capital equipment business, where progressively lower advances have been received from customers, and certain very, very large projects were executed where the customers had a substantial, I would say, negotiating position on the payment terms.
Okay, so what will be your net working capital days in going ahead? Last year it was 74. This year, what should it come down to? I mean, or do you expect it to be at these levels?
So Nigel, even this year we expect it to be near the 70 days mark, a few days here or there.
Okay, all right. Also, I wanted to ask you about, you all have taken a resolution to raise some money, a fundraise, I think 350 crores odd. What is happening on that? Should we hear about some fundraise in this year? Point number one. And also, I think your interest cost per quarter is approximately, I think, 9 crores approximately. Could you tell us what is the current debt in the books as well?
Nigel, I will probably take the question on the fundraise provision that we have taken. So there are three main purposes behind this. Number one is we want to broad base our investors. So we are looking for quality investors. We are looking for FIIs, DFIs, mutual funds, insurance companies to invest in our company. So we have been in discussion with various such institutions on this process. We also want to increase the free float in the market. So that is the first purpose, for which we would do that. The other thing is, of course, if we raise this fund, we will reduce the debt, increase the strength of the balance sheet. And that will definitely help in lowering the cost, the interest rate, as you just mentioned.
What is the debt on your books? What is the current debt on your books?
So the current debt on our books is around 240 crore. And we have taken a provision to raise 350 crore. That's what we have enabling provision we have taken. And the third purpose is that as we are a growth oriented company, we are looking for inorganic growth all the time. And if the right opportunity comes by, this will help us to raise the fund quickly and make a quick move. That is the main purpose for.
Okay, all right. So you could raise some money is what you're looking at for broader participation. You're talking about debt reduction and also you're talking about inorganic growth. Will you be doing that this year? Will you be raising some money this year? And what is the preferable route? Are you looking at a preference issue since you're looking at some big names, FIs, etc., is what you're mentioning? Or will it be a QIP?
So we will wait for the right opportunity and the right market conditions to raise the debt. The timing is slightly flexible from our end, and it will most likely be QIP. But we are still open to other options. But it will most likely be QIP route.
Well, the street will be closely watching that, mainly because even as you do have some investors like Malabar India and a bunch of HNIs holding stock, there is no domestic mutual fund that holds the shares of HLE Glascoat as well. Just wanted to understand, the promoter stake too is down from 74% to around 70% from June 2020 to now. The other thing that stands out is your asset turnover ratio over the last 4 years has come down from closer to 4 to around 2.5. Is it because you are investing ahead of time, and should we see this go ahead? What can you guide for in terms of top line and operating cash flows?
Yeah, hi. So I think in terms of asset turnover ratio, I think the asset turnover ratio for us predominantly depends on what kind of capex cycle we have recently undergone. So historically, we have always done modular expansions where we have one site where we have an existing facility to which we keep adding bays in a modular fashion. So the asset that we add to create additional turnover is relatively low. So what has happened also in the recent past is that we have made two large expansions. So one is a greenfield expansion that we made at our Silvassa plant. So that plant, which was historically a 2,500 square meter plant, we have now built around a 7,000 square meter plant with an addition with a total land area of around 20,000 square meters available to us. So what happens when we do a greenfield is that you would see a slightly lower asset to turnover. So which is why you see around a 2.5 times turn. I think for us, as we add more bays in a modular fashion to the existing expansions, we would come back to the 3.5 range. That's the expectation.
Okay, asset turn of 3.5. Final question then. We didn't get clarity on the top line growth. Last year, you did around 920 crores. Things are ramping up. Order book as well is okay. That 15 to 20% is for this year in terms of a top line growth?
Yes, we feel that a 15 to 20% growth is doable this year.
And promoter stake stabilizes. And promoter stake stabilizes at what level? You said you are looking to, increase the free float of the company. Promoter stake down from 74% to 70%. How much below can it go from here?
So I think, as I discussed, it depends very much on the opportunity at hand. But with the provision that we have taken, even if we exercise the entire 350 crore provision that we have taken, we would still not be below 66%.
Okay. All right. But the promoter selling stake, that is separate from bringing money into the company. So do the promoters want to sell any stake is the question that we're asking.
So this QIP provision is a mix of primary and secondary provision. So it depends. If we need promoters, it is not our intention to lower our stake in the company. It will most likely could be the primary dilution.
All right. Harsh, Aalap, thank you so much for joining in and giving us the views on your company. Of course, we will focus on the execution as against the commentary that you've been made here. Take a short break, come back, tell you more on the markets and individual stocks. Stay tuned.